This is the Sensei podcast, where we help you make sense of investments and financial markets, where we help you make sensible financial choices. I am your host, Ndwati Karanja. At the moment, in Kenya, nearly 97% of the CDS accounts that are used to trade in stocks that are listed on the Nairobi Securities Exchange are dormant, 97%. And back in 2019, this number was 88%. That is a huge number of people who have opened these accounts for trading shares and ended up abandoning them. Why do you think they did this? In my own opinion, is that there are over 60 stocks on the Nairobi Securities Exchange, and it is not always easy to pick the right one. Therefore, in the past, maybe we've gotten overwhelmed. We don't know what to do, and we don't know where to get started. Or if we got started, we found that our investments did not yield much returns for us, and we end up backing away from directly investing in stocks. However, stocks are an important part of your portfolio. If you're going to achieve your dreams, if you're going to achieve your retirement targets, it is important for you to invest in stocks because of the higher returns that you might get. If you're doing it right, then you will get in either bonds or money market funds. Therefore, in this episode, we are going to make investing in stocks less scary, less overwhelming, and hopefully more profitable for you. We're going to talk about the different ways that you can invest in stocks, and then we're going to pick one particular way, which is called index tracking. And finally, we are going to conclude by talking about some things that you need to think about when you are using this index tracking. So let us get started. When you invest in stocks, there are two ways that you can go. You can either go the active way or the passive way. Active portfolio management is where you attempt to outperform the market in general by choosing investments that are likely to give you high returns. When you think about active portfolio management, think about those stereotypical stockbrokers. I think you've seen them in movies probably, where people are on the stock market's floor and they're yelling buy, 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 or sell, sell, sell. So that is the kind of image that should come to your mind. These are people who are trying very hard to find the right stock. They're trying to profit from short-term fluctuations in the prices of stocks. They're trying to buy stocks at the right time and then sell them at the right time so that they're going to make a profit. Think about someone who is investing very actively. They are checking the market every day, every other day. They are also making either a purchase order or a sell order. That is the first way that you can invest in the stock market actively. However, it is also possible for you to invest in the stock market passively. And in this situation, what you're trying to do is you're trying to buy certain stocks and then you hold them for a long time without making much changes to them. The assumption behind this passive investment is that as time goes by, your portfolio is going to do as well as the market. You're going to benefit from the general increase in the price in the stock market, and it's going to be a good return for you. Therefore, those are the two ways that you can approach investing in the stock market. First of all, you can go the active portfolio management way, where you are actively trying to choose the right stocks. However, on the other hand, you can go the passive portfolio management ways. What I would like to recommend for you is going the passive portfolio management ways. And the reason for this is that it has been found by studies all over the world that people who use the active management style of investing rarely perform better than the market in general. Actually, people who invest passively are more likely to outperform those people who are doing it actively. And one strategy that has been found to do better than the people who are actively buying and selling stocks is the index tracking. And this is what we are going to talk about next. Index tracking is where you're trying to select a portfolio of stocks that are going to do just as well as the market. You pick an index and then you track that index. An index is a figure that is calculated at the end of the day or during the day while stocks are being traded. And the purpose of that index is to give you an impression of how the market is performing in general. I think probably you've heard of the NSE 20, you've heard of the NSE 25. These are indexes that are used to gauge how well the market has been doing over a certain period of time. And therefore, when you're index tracking, what you're doing is you either pick the NSE 20 or the NSE 25, then you create a portfolio that is going to track the performance of that index. How do you create that portfolio? First of all, you could go the way of full replication. Let's take the example of the NSE 20. The NSE 20 is based on the performance of 20 of the biggest companies that are listed on the NSE. So you identify those 20 companies. They're usually listed on the NSE's website, and then you buy shares in each of those companies, and therefore in the process you replicate that NSE 20 index. At the moment, for you to replicate the NSE 20 index, you would need 125,000 shillings to buy all of those 20 stocks that you need. Once you've bought them, you hold them for the long term. The other way that you could go if you do not want to buy all those 20 stocks because they can be quite a number, you can do something that is called stratified sampling. And in this situation, rather than buying all the 20 stocks, you sample stocks from different sectors. For example, you could decide to only invest in 5 that are approximately the same as the NSE 20. And those 5s could be, for example, EABL, ABSA, Bank, KCB, Safaricom, and Equity. These represent different sectors, and when you invest in them, you kind of track the NSE 20. Those are the two ways that you can track an index. First of all, either you pick an index and then buy all the stocks that make up that index. We use the example of NSE 20. Those are 20 stocks that you can find on the NSE website. Or you could do a kind of sampling where you just pick 5 and you invest in those 5s that kind of replicate the performance of the index. However, once you've invested in those stocks, there are certain things that you need to do periodically. You need to do these things because the index tracking is not an absolutely passive one. There are certain actions that you need to take, let's say every 6 months or every at least once a year. However, before we get to that thing that you need to be doing every 6 months or once a year, you need to remember that this is a long-term strategy, and therefore you need to resist the urge to actively manage your portfolio during the bad years. Let me explain. Over the last 10 years, 4 years have resulted in negative returns on the stock market. Therefore, on those years, you will have seen your portfolio shrinking in value. And what you need to realize is that this is a long-term strategy that you need to, even during those bad years, you need to stick with your strategy. Otherwise, it is not going to work. Because even though those 4 years had negative returns, the other 6 years made up for those negative returns. If you had held your position over the 10 years, you will still have come out in front. Remember, that is the most important thing about this strategy. Do not switch the strategy in the middle of time when things seem to be going bad, because then you're going to lock in your losses. However, if you stick with the strategy for the long term, you'll find that the good years are going to outweigh the bad years. Therefore, once you've remembered that, the thing that you need to do periodically is to reconstitute your portfolio. In 2016, 2018, 2019, and 2022, the NSE 20, the stocks that make up the NSE 20, those 20 stocks that are used to measure the performance of the market, were reconstituted in those 4 years. And therefore, you need to watch out for when the Nairobi Securities Exchange reconstitutes the the index, and therefore you buy the stocks that are now being brought into the index and then sell the stocks that are being taken out of the index. That way you make sure that you're always tracking the NSE. Therefore, remember those two things. First of all, it is a long-term strategy. Do not switch out of it in the middle of the way. If you switch out of it during a bad year, you're not going to get the benefits of the good year. And second, need to keep an eye out for when this index is reconstituted, and then buy the ones that have been brought into the NSE 20 and then sell the ones that have been taken away. Let us conclude. Therefore, investing in the stock market does not need to be a mystery, or it doesn't need to be unprofitable. You don't need to be overwhelmed. By following this simple strategy, the index tracking, you can gain the benefits of investing in the stock market. First of all, there are two ways of investing in the stock market: active management or passive. And in this episode, we are talking about the passive investment that is called index tracking. You can track an index either by fully replicating it, buying all the shares that make up that index, or you can partially replicate it by buying a few representative shares and investing in them. Remember that this is a long-term strategy. That is the most important thing that you need to keep in mind. Therefore, you need to stick with it for the long haul if you're going to make the profits. And then remember to always watch out for when that index is reconstituted. It's always posted on the NSE website, and reconstitute your portfolio to reflect those changes. You cannot avoid investing in the stock market. Bonds, SACCOs, MMFs can't give you the returns that you need to achieve your retirement goals. Index tracking is an effective way to gain the benefits of investing in the stock market. This has been the Sensei podcast. We release new episodes on Wednesdays and Fridays. Please subscribe and leave a comment on your favorite podcast provider. I am Ndwati Karanja. Until next time.